Now let's take a quick recap on the lending process. So when you want to get a home loan, first thing you're going to do is go to a lender. They're going to have you complete an application. They're going to look at the debt to income ratios. In other words, can you afford the house payment that you are looking at? Now, if you haven't done any home shopping, then they will do the debt to income ratios and tell you how much money you can afford. Now, what do we mean by debt to equity ratios? In other words, they're going to look at, first of all, the proposed house payment versus your gross monthly income. Most lenders will say they do not want you to exceed 28% plus or minus to maybe 30% of your gross income. So just very easily, so we all understand, if you made $1,000 a month, then your proposed house payment should not exceed $300 if it's a 30% loan to value ratio. The next step would be to look at all of your debt and then weigh that against your gross monthly income. And those ratios can be anywhere from 36 to 41%. So they're going to look at those two things. They're going to then give you a pre-approval. You'll go out, look at a home and find a home that you want. And then the lender is going to verify your rent, or if you own another home, they're going to verify your credit report. They're going to verify your job to make sure that you've been on your job. They're looking usually for people who've been in the same line of work for a year to 2 years. So they're going to verify things such as, again, your credit report, but they're also going to verify your job. They'll verify where you are living at now to make sure you're making those payments on time. And then if all of that checks out okay, they will order the appraisal once they find the home that you once you have found the home that you want to purchase. And through the appraisal, once that comes in, everything gets sent to an underwriter who looks over all of the documentation. And if everything checks off, because they will make sure the I's are dotted and the T's are crossed, then they will order the title insurance and prepare you for the loan closing with the escrow agent. Now, I will make one little comment here. It's important that when a buyer gets approved for a loan, they don't go out and borrow additional money or do something that could change their credit standing. Because sometimes lenders will, the day before closing, pull a new credit report, and if there are additional obligations on there, they could throw your debt to income ratios off. And I personally have seen transactions fall apart because a buyer went out and purchased furniture or a new car or something else, and when the lender pulled that credit report, the debt to equity ratio was out of sync and they didn't qualify, and the loan actually fell apart and the transaction fell apart, and nobody was happy in that situation. So hopefully that gives you a little bit about the process, but remember the debt to income ratios, that's a procedure. Remember the fact they're going to check credit, they're going to verify where you're living, they're going to verify your employment. And then finally, this has been seen on the exam, who's the last person to sign off on everything to give the final approval? It's the underwriter.